This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Global pain. The worldwide sell-off started in China, spread to Europe, and battered stocks here in the U.S., sending the Dow Jones Industrial Average lower by nearly 300 points. Earnings on deck. Attention now turns to next week and what the flood of profit reports could mean for the market and your money. Flagship Fund, the man who runs the world's biggest bond fund, is outperforming his peers and shares his thoughts on the economy, fixed income, and the Fed. All that and more tonight on Nightly Business Report for Friday, April 17th. Good evening, everyone. I'm Sue Herrera. Tyler Matheson is off tonight. Stocks got slammed. The major averages spiraled lower. The Dow Jones Industrial Average plunging nearly 280 points, its biggest one-day drop since the end of March, as global concerns took hold of stock markets across the globe. The sell-off started in China with a regulatory move, then spread to Europe on a new round of Greek worries, and it found its way here to the U.S. By the close, the Dow Jones Industrial Average sank just about 280 points to 17,826. The Nasdaq dropped 76 points, and the S&P 500 gave back 24. And it was pretty much a losing week for all the major averages. Bob Pisani takes a look at the issues unsettling this market.
A crackdown by Chinese regulators and continuing concerns about a Greek exit from the euro put pressure on stocks today. It was a fairly uniform sell-off on heavier than normal volume. All the major U.S. indices were down more than 1%, as were almost all of the 10 S&P 500 sectors. Not surprisingly, the more volatile stocks in the internet space and the solar space and semiconductors were down even more. European stock markets dropped roughly 2 to 3%, with the biggest down moves in peripheral countries like Greece, Russia, Italy, and Portugal. Remember, all the European bourses are up double digits this year, as the European Central Bank has sought to weaken the euro and prop up the economies there. So there's a lot of profit locked up in Europe right now. Today, a lot of the traders decided to lighten up. After the close in China, regulators instituted a crackdown on stock margin trading in over-the-counter stocks. Now, this is an issue because investors there have been pouring money into small-cap stocks for a good part of the year. Because the market was closed over there, the news was not reflected in the markets there right now, and the Shanghai index was up 2.2%. However, China ETFs traded lower by about 5%. Finally, traders were looking forward to a big week of earnings. The worry is that while earnings reports are roughly in line, revenue is continuing to come in on the light side. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Our market monitor joins us now to talk more about today's sell-off and also to prepare us for next week. He is Michael Cugino. He is the president and portfolio manager of the Permanent Portfolio family of funds, an investment firm with $5 billion under management. Good to see you, Michael. Welcome.
You as well, Sue.
So talk to me about what happened today. It wasn't just the global sell-off. You think a couple key data points might also have had something to do with it?
Well, sure. I think the one thing, obviously the things that you and Bob mentioned are accurate, but also I would say the inflation data coming in today was getting awfully close or exceeding the Fed's target of 2%. And I think you get back to the very big concerns in the U.S. about the closer the Fed gets to its inflation target, employment targets, the more likely they're going to start raising interest rates. And so, whether you consider food and energy or not, you're getting around that 2% or exceeding it. Mm-hmm. And that means the pressure on the Fed to act more quickly than normal is there. Are
you one who thinks that the Fed will act in the second half of the year or any time this year or not?
Well, certainly they could, although I wouldn't be surprised if they do nothing. I mean, the U.S. economy is showing some weakness. We're still trying to figure out if there's sustainable growth there. Corporate earnings may have seen the peak of their cycle. They're being hurt by strong dollar issues and weakening global economic growth. And so those factors are weighing or giving the Fed more wiggle room to delay. On the other hand, arguably, a return to normalized interest rates, I think, would have been a good thing to do a long time ago. So I'm in the camp that they should be doing something. But even if they do, I think there's a limit to how far they can move. The U.S. economy isn't strong enough to withstand an aggressive, quick move. And so, and also an increase to the deficit if you start raising interest rate costs. So I think it's going to depend on how aggressive, how quickly they move, and how much the U.S. economy can sustain.
We certainly saw a lot of volatility about earnings. We have more earnings next week, and I want to get to some of your picks because they are all reporting next week. You like Facebook at this point. Why?
Yeah, it's a classic early stage growth story. They've got a tremendous intangible asset of information, and they're still discovering new and better ways to monetize that information. I think they're going to continue to do that. We've seen it grow into its multiples. It's not a cheap stock, but revenue growth, earnings growth, cash growth are all there, so we like it in the long term.
And you also like Janus.
Yeah, financial services, asset management, a business we know well. There's a lot of operating leverage there. Their funds are performing better. Whether the Bill Gross addition succeeds in the long term or not, they're still doing very well. The margins are improving, and fund performance has been better. So we expect that stock to continue to outperform.
And a play on commodities in Freeport-McMoRan, energy and copper.
Yeah, an area that's not too well liked right now, but it's tremendously oversold. We think in the long term, supply is going to outstrip, demand will outstrip supply, and there's a good dividend there. They're in energy and copper primarily. We think those are commodities that the world's going to need. So this is one of those classic buy low and ride the story if you have a strong stomach types of names.
All right, Michael, have a great weekend. Thanks so much for joining us tonight. Michael Cugino with the Permanent Portfolio family of funds. General Electric, the nation's largest industrial company, reported better than expected profits in the face of a strong dollar and weak oil prices. And the results come just 1 week after unveiling its plans to dramatically shrink its finance business. Shares of GE started the day higher, but were unable to hold on to those gains by the close. It ended slightly lower. Mary Thompson has more.
While General Electric's first quarter profits declined from a year ago, CEO Jeff Immeld's team kept a tight rein on expenses, driving a bottom-line beat.
GE had a good quarter in a slow growth and volatile environment. We're seeing the world that we planned for.
GE does business in over 170 countries, so the stronger dollar trimmed almost $1 billion from the company's revenue, while expense controls and strong performances by businesses making jet engines and locomotives fueled earnings that, excluding a charge to shrink GE Capital, beat estimates by a penny.
You saw gross margins expand, you saw operating margins expand, and it's because they're on this $1 billion a year simplification program.
Squeezing out costs is one reason GE sees industrial profits tracking at the high end of earlier guidance for this year, along with above-trend results in its aviation business. This despite GE maintaining profits in its oil and gas business, once a growth driver, will decline by as much as 5% this year. Oil prices cutting into the unit's orders, so GE's cutting the unit's expenses by $600 million. The first quarter results a testament to GE's ability to drive efficiencies in its industrial businesses, which it says will generate 90% of its profits by 2018, all part of a new strategy to exit most of its finance business by selling billions in assets over the next 2 years. It's also the latest makeover by Immelt. One analyst, Steve Winokur, sees achieving the goal of creating an easier story for Immelt to sell, that of a high-growth industrial firm.
The portfolio change, the cultural change you're seeing coming out in the actual costs every quarter, these are all indicative of truly, I think, a company that is transforming, that is very different today than it has been over the last 15 years.
And with the stock down over 50% in the past 15 years, investors hope that difference generates a different return. For Nightly Business Report, I'm Mary Thompson.
And now to earnings from another big industrial, Honeywell. The company reported a 5% drop in quarterly revenue, primarily because of that strong dollar. The company also cut its full-year revenue outlook, but it raised the lower end of its annual profit forecast as market share gains are projected to offset declining revenue. The stock dropped more than 2% in the trading session. And on to the economy, which saw consumer prices tick higher, a possible sign of emerging inflation. The Consumer Price Index, which measures what Americans pay for just about everything, increased for the second straight month by 0.2% in March. But compared with a year earlier, core prices, which exclude food and energy, climbed 1.8%. Meantime, the yield on the Treasury year bond, the 10-year, remains solidly below 2%. Our next guest runs the world's biggest bond fund, and he's here with us now to share his analysis on the financial markets, the economy, the Fed, and what it all means for investors. He's Scott Mather. He's the Chief Investment Officer of PIMCO's flagship Total Return Fund. Good to see you again, Scott. Welcome back.
Good evening, Sue. Thanks for having me.
We noted last night how well the Total Return Fund has been performing. You are outpacing your peers by better than 90%, and you've turned that fund around. How did you do it?
Well, I'd like to tell you it's all myself, but it's really not. We have a process here. It's always a large team of people involved in designing the strategies and the individual securities that we're selecting for the fund. So we have 260 portfolio managers, and they're all an integral part of the strategy-making process. So it's really using the same people, the same processes that have allowed us to outperform over numerous market cycles for decades. So we're just returning the fund back to where we normally spend most of our time, which is at the top of the league tables.
Indeed. Where did you find the best trades, the best value in the market? Because you've basically been looking all around the globe as well as in the Treasury market. So where did you find the most opportunity?
Well, there's a few important themes. One, we've been very focused on monetary policy divergence. That's a theme that there's many different strategy implications, many different things we've been doing in the portfolios to take advantage of that. We do believe, for instance, that the Federal Reserve is going to begin moving interest rates in the summertime, even while other central banks are very actively easing monetary policy. So we've had a number of strategies in place in the portfolio to take advantage of that and to prepare for that. Some of the things that have worked particularly well are a focus on European bonds, which have been outperforming U.S. bonds. Our focus on looking for other areas in the world where monetary policy and rates won't be tied to the U.S. rate cycle, places like Mexico, for instance, for local rates. And of course, there's many other, one of the follow-on themes from this is continued dollar strength, and that has implications not just for the currency positioning, which has worked out well for us, but also for a lot of the individual sectors we're investing in the corporate market.
What about Greece, Scott? Because that seems to be roiling the equity side of the market, and it's sending some money into fixed income on various parts of the U.S. yield curve, but also in Germany as well. And there's a lot of talk, as I'm sure you're well aware, that we may see negative rates in Germany. How big a factor is Greece at this point?
Well, it's an important factor, and obviously today it was one of the main things that was driving markets across the world. You know, Greece is certainly not a very significant portion of the global economy, not even a very significant portion of the European economy, but it is very important. There are all sorts of unknowns about, you know, what happens if a country does go down the path of exiting the monetary union. And you know, our base case expectation is that Greece manages to find a way to stay in the monetary union, manages to muddle through this. But with each day that passes, it is certainly getting worse and worse for the Greek economy. It means they're getting deeper and deeper into recessionary territory. They need more money from their Eurozone partners. So, you know, the risks of a disorderly outcome certainly for Greece are rising, and that will have implications for Europe and the global economy through financial market channels and through confidence channels.
You mentioned your forecast for the Fed. We saw the inflation figures come in this morning, and that kind of upset the equity side of things. What about inflation-linked bonds? Is that part of your portfolio? Is that a strategy that you've been employing or not?
Yes, absolutely. Inflation-linked bonds, they started the year very cheap, and so we've had positions to emphasize owning inflation-linked bonds over nominal treasuries, for example. Those positions are beginning to pay off, contributing to performance of the fund. We think there's a lot more room to go, though. The market was very preoccupied as we started the year about disinflation and about the ability of a drop in energy prices to somehow filter in a lasting way. The market was basically pricing that the Fed would fail to meet its policy objective for 10 years or longer. So it's a very good opportunity. We think that inflation-linked bonds, although they've bounced and are performing well, they have a lot further to run. As it becomes clearer that inflation is definitely headed up. It's headed up because wages are headed up, and also because the effects of that big drop in energy prices is going to pass and move away from influencing headline inflation.
All right, Scott, we'll leave it there. Continued success. Thank you so much for joining us. Scott Mather with PIMCO. Still ahead, a major cable TV provider just made a big move that could further shake up the television industry. President Obama defended his pursuit of that sweeping trade pact that we told you about last night. The president says the deal with 11 other Pacific nations is good for American workers in a global economy, dismissing opposition from his own party.
What we are doing is negotiating the highest level, highest standard trade agreement in our history with strong enforceable labor provisions, strong enforceable environmental provisions. And I will be able to show, when the final agreement is presented, that this is absolutely good for not just American businesses, but for American workers.
But those opposed to the Trans-Pacific Partnership say it will cost American jobs, since global trade will make some positions obsolete and possibly damage the environment. Attorneys at the Department of Justice may be close to opposing Comcast's $45 billion proposed acquisition of Time Warner Cable. According to a report by Bloomberg, lawyers in the Antitrust Division are nearing a recommendation to block the deal because of concerns consumers would be harmed. The review could be submitted as soon as next week. Shares of Time Warner Cable fell more than 5%, and Comcast, the parent company of CNBC, which produces this broadcast, dropped 2%. And now to another cable company that is trying to keep up with the changing way that people watch TV. Verizon is rolling out a new pay plan that's a big departure from the traditional model of cable bundling. Julia Borston takes a look at just how disruptive this move could be to an industry already undergoing enormous change.
Verizon wants to give consumers a new way to pay for TV. Fios's new custom TV packages will allow consumers to choose every month which channels they want to see.
I think about millennials and how millennials are viewing video today, for example. The plans that we're launching, Custom TV, gives the customer a simple, customizable package of content that they can then have the base and have local, which local is very popular. But then choose from genres that are specific to their tastes and what they want.
The packages start at $65 a month for broadband service, plus 36 basic channels, and a choice of 2 of 7 channel packs, including sports and kids programming. Additional channel packs will cost $10. What makes Verizon's new offering unique is the ability to swap out options every 30 days instead of locking consumers into long-term contracts. It's a move to address consumer demand for a la carte options.
Increasingly, customers want to pay for what they use, and we're not all the way there today in terms of a la carte, but we believe it's our opportunity when we sit with the content partners to represent what we hear from customers.
But with so many a la carte options out there like Netflix, Hulu Plus, Apple's iTunes, and now HBO Now, many say that this kind of new option isn't enough to prevent consumers from cutting the cord with TV bundles from cable, satellite, or telecom companies.
The cable companies still have not gone far enough. And when you look at the trends with cable cutters, it's still low. It's still in the single-digit percentages. But I think that given the latest moves with HBO and other networks, you're going to start to see that happen much, much quicker.
But in the meantime, the question is whether this helps Verizon's Fios, which is in 6th place when it comes to pay TV providers, make gains on its larger rivals like Comcast and Time Warner Cable. For Nightly Business Report, I'm Julia Borston in Los Angeles.
A giant drug merger might be brewing between Mylan and Teva Pharmaceuticals, and that's where we begin tonight's market focus. According to reports from Dow Jones, Teva is exploring a takeover offer for Mylan, a move that would create a huge generic drug player. But Mylan responded to that report by saying it is fully committed to its standalone strategy and to the proposal that it made earlier this month to buy Perrigo for about $30 billion. Mylan popped 4.5% to $69.82. Teva also rose more than 2% to $64.91. Shares of Seagate popped despite a big decline in earnings. The data storage company blamed poor economic conditions. It still managed to top the street's profit estimates, but revenue missed. The stock was more than 2% higher to close at $57.43. Reynolds American reported a beat on both the top and bottom lines. The cigarette maker saw declining sales and a smaller market share, but it was able to benefit from higher prices. Shares were up just a fraction to $74.70. Procter & Gamble is hiking its dividend to 66 cents a share. That will be payable to shareholders in mid-May. The yield on the company's payout is about 3%. Despite that, shares fell 1% to $82.53. The Department of Transportation wants to improve the safety of oil being transported by train. In a letter to the rail industry, the agency said train operators must have detailed information about the possible cargo risks and perform more thorough checks before moving on the tracks. A comprehensive national oil train safety plan is expected in the coming weeks. The Obama administration is also proposing rules that could raise the fees paid by oil and gas companies to drill on federal land. The regulations would give the government more flexibility to set fees. A low royalty rate encourages oil and gas exploration, and any increase would likely raise concerns from the industry and potentially lessen production. Schlumberger, the largest oil field service company in the world, reported a sharp drop in profits and announced plans to cut thousands of workers. The results reflect a broad slowdown in drilling for oil and gas. And as Morgan Brennan tells us, this energy industry bellwether says any recovery will look starkly different from the ones that have come before.
Schlumberger's results represented an almost 40% plunge in profit from a year ago. But as oil prices have halved since last summer, that decline was still less than analysts had feared.
The earnings beat was attributable to very aggressive and proactive cutting of costs in the face of a major downturn in North American drilling and in the international arena as well.
Part of the cost cutting? More layoffs. An additional 11,000, bringing the total number of job cuts at Schlumberger up to 20,000, or 15% of its global workforce. The energy giant also offered a cautious outlook, particularly for North America. In the earnings report, Chairman and CEO Paul Gibbsgard said the company believes a recovery in U.S. land drilling will, quote, be pushed out in time as inventory of uncompleted wells builds and the refracturing market expands. While the number of active oil rigs in the U.S. has plunged by more than 50% just since the fall, some producers, including EOG Resources, Anadarko Petroleum, and Apache Corp, have drilled thousands of future wells before idling them. But with crude prices so low, they've also held off on actually fracking them, the final stage of drilling that releases the oil and gas from the earth. It's that growing backlog of uncompleted wells that could slow the pace of an oil recovery.
We're close to a bottom, but as we start to see a recovery, it will be very gradual. And there is an inventory of drilled but uncompleted wells that will be the first priority for the oil companies.
For that reason, says Shoemaker, it won't be until next year that demand for drilling rigs like Schlumberger's begins to pick up in a meaningful way. For Nightly Business Report, I'm Morgan Brennan.
Still ahead, the big, very big business of boxing and all the money behind the matchup being called the fight of the century. Here's what to watch for next week. Dow Components DuPont, Boeing, McDonald's, and Coca-Cola will report their results. Also, some of the biggest names in tech will release earnings, including Yahoo, Facebook, and Google, among others. And plenty of data with existing home sales, new home sales, and durable goods. And that's what's on the agenda for next week. Bloomberg's financial terminals went down around the world today, paralyzing a lot of investors. The blackout, which started right after the European markets opened, caused the UK to postpone a multi-billion-dollar government debt buyback. The terminal is a software system used by market participants globally. It was restored a couple of hours after the market opened on Wall Street. The richest boxing match in history is less than 3 weeks away. And no matter who wins the Manny Pacquiao-Floyd Mayweather fight, a lot of money will be made. And the numbers are eye-popping. Jane Wells has more.
In the biggest prize money match ever, it's the fighter who chews on dollars against the one known for pounds.
Manny, over here.
The Manny Pacquiao-Floyd Mayweather fight next month in Las Vegas could bring in $300 million, maybe $500 million if pay-per-view sales exceed expectations. The so-called fight of the century has been years in the making, with Mayweather, the undefeated favorite, needing convincing.
Is the only reason this fight happened was because you were willing to take less than half?
Yes, 60-40, and agreeing what he wants.
Even at 40%, Pacquiao will make at least $80 million. But win or lose, Mayweather gets a guaranteed $120 million, which could go higher, setting a record for an annual athlete's payday in no more than 36 minutes of work.
It's a little bit about the money. It's about the fans. It's a little bit of everything wrapped in one.
Tickets on the secondary market are already selling for as much as $65,000, even though last-minute haggling has prevented tickets from actually going on sale. Could haggling prevent the fight?
In the documents, we have all agreed that if there is a dispute, Les Moonves, the chairman of CBS, I kid you not, it's right in the document, is the arbitrator to settle all legal disputes.
Both sides are sparring verbally, even when talking potential rematch.
It all depends on, what round we knock him out in and so forth.
While behind the scenes, the preparations continue. Dentist Lee Goss helps Mayweather put his money where his mouth is with flamboyant mouth guards of gold or stuffed with $100 bills. So high-tech, the fighter breathes better with the guard in than out.
We charge Floyd roughly 25 grand, maybe a touch more.
And for all the talk that this is more about history than money,
our focus isn't the money, the money will come.
Assuming nothing stops the fight from happening, everyone will go home rich.
How much money do you make on this fight?
A lot.
For Nightly Business Report, Jane Wells, Los Angeles.
Wow. That's Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us. Have a great weekend, everyone, and we'll see you Monday.